Let's do this exam. Below is some information on Ford and GM. We have market cap in billions. We've got some balance sheet items also in billions. We have some income statement and cash flow statement items. We've got the earnings per shares. We've got dividends. What are Ford's and GM's enterprise values? Well, enterprise value is just the market value of equity plus net debt. So can we calculate net debt? Sure, net debt is going to be helpful. That's just total debt. Oops, can do it this way. Total debt minus cash is net debt. Very good. And then enterprise value is going to be market cap plus net debt. And we can copy that to the right. And here we go. Here is the answer. An EV of Ford is slightly higher than the EV for GM. Using the information above, what are Ford's and GM's share prices as of June 2nd, 2023. So we've got the market cap. So obviously share price is just the market cap divided by shares outstanding. Do we have shares outstanding anywhere? No, but we do have net income and earnings per share. So we can calculate shares outstanding. It's just the ratio of net income, it's in billions, divided by shares out earnings per share. It's going to give us shares outstanding in billions. So 4 billion shares for Ford. And then the stock price, share price is going to be market cap divided by shares outstanding. So it's $12.31 for Ford and $32.98 for GM. Question 3. Since GM's current stock price is higher than Ford's, GM is doing better than Ford. That statement is false. Stock price depends on the number of shares outstanding. Number of shares outstanding is arbitrary. Company can issue 1,000 shares or it can issue 10,000 shares. In this case, GM has only 1.4 million shares outstanding. So given that they have roughly similar market cap, share price is a little higher. Doesn't mean that GM is doing better in any sense. Tomorrow, GM could decide to slice each share in 10 different pieces, and the stock price could go down from $32 to $3, and nothing material would change. So this statement is very much false. Is GM more profitable than Ford? So we've got different profitability measures. Unfortunately, we don't have revenues. We can't calculate gross. Well, we can calculate profit margin or gross profit margin since we don't have revenue. But we have EBITDA. We have net income. So we can also calculate shareholder equity. Shareholder equity. That's going to be just total assets minus total liabilities. And once we have shareholder equity and we have net income, we can calculate return on equity. We can probably also calculate return on assets. And let's do that. So return on equity is going to be net income divided by shareholder equity. Return on assets is going to be net income divided by total assets. assets are here. Let's copy that to the right. Let's format these guys as a percentage at some decimal places. So we can see that GM is clearly much more profitable. It's got a higher return on equity, higher return on assets than Ford. It's got higher net income, really. We're looking at 2.9 billion versus 9.4 billion. So GM is more profitable. Is GM a better value? So we need to use some relative valuation metrics. How about let's calculate PE. Let's also calculate price to book. What else could we calculate? We could also calculate EV over EBITDA. So P price over earnings would be just market cap divided by net income. You could have also done it by taking the share price, dividing it by earnings per share. We would get the same number. Price to book is going to be market cap divided by shareholder equity, and shareholder equity we already calculated helpfully over here. EV over EBITDA. We know that this is EV, and we got the EBITDA here. Fantastic. Let's do that for GM as well. And what do we see? We see that these valuation ratios are lower, actually much lower for GM than Ford. GM appears to be better value. It's cheaper relative to the earnings, relative to the book value. Its price to book is actually less than 1. So if the accountants are right, we could buy GM's assets for only 68 cents on the dollar. Okay, what is the intrinsic value of Ford and GM's stock according to the dividend discount model? We can assume that dividends will grow at 4% per year indefinitely. And that the required return on equity is 8%. Is GM stock a better value than Ford's? So how can we do this? So we could say intrinsic price according to DDM. Well, that would be taking the dividend, which is it's an annual dividend, last 12 months, divided by 1 plus the growth rate. Growth rate, they said, was 0.04%, dividing that by the discount rate, which is 8%, minus the growth rate, which is 4%. And this is the intrinsic price for Ford. Actual price, let's actually compare them. We calculated that over here as 12. So Ford appears to be actually undervalued by the market. And GM appears to be definitely overvalued. Its stock price is 32, and according to the dividend it pays and the rate of growth and discount rate we assume, it should be only $9. Is that the GM dividend is much smaller. It's about half of Ford's dividend. So if we really just pay attention to dividends and we assume the same growth rates and the same discount rates, GM appears overvalued. Ford appears to be the good value here. What are Ford and GM's free cash flows in the last 12 months? So how can we calculate cash flows? Let's actually calculate them 2 different ways. We're we're going to need depreciation to do that. Depreciation. Do we have depreciation numbers? We do have the difference between EBITDA and EBIT. That's just depreciation and amortization. The difference. So it's about 6.6 billion for Ford. So let's calculate free cash flow, and let's do that as net income, to which we're going to add depreciation. Add depreciation back in because we're looking at cash flow. We're going to add interest because we also want cash flow, free cash flow that goes also to debt holders. So interest expense is here. We need to subtract capex, and we need to subtract change in net working capital, because if net working capital goes up, that's a use of cash. If net working capital needs are going up, it reduces free cash flow. And fantastic, that's 3.5 billion for Ford. We could also calculate free cash flow using our EBITDA. And from EBITDA, we can subtract taxes, because we do have to pay taxes. So it takes away from cash flow, and EBITDA is before we pay taxes. And from that, we're going to subtract also capex. And we're going to subtract change in net working capital, which is here. And we get the same amount. We get the same number. So let's do this also for GM. Control R. And we see that GM actually has a negative free cash flow. Okay. Suppose that Ford's WACC is 7%, and its free cash flow is expected to grow at 4% per year indefinitely. What is Ford's intrinsic value according to DCF model? Is Ford's stock overvalued? So we're doing this just for Ford, mostly because we have negative free cash flow for GM. So here there's no projection period. So we just need to figure out the terminal value of the free cash flow, 3.5, growing indefinitely. So that will be last 12 months free cash flow that will grow at 4%. From that, well, that divided by the WACC minus the growth rate, 0.4, and that's giving me intrinsic enterprise value. Intrinsic equity value is going to be intrinsic EV minus net debt. And so here it's going to be very helpful that we have net debt over here. So equity is just 11 billion. Intrinsic share price is going to be, since this is in billions, it's going to be the equity value, intrinsic equity value, divided by the number of shares outstanding, which is in billions. So this is in dollars. So the intrinsic share price of Ford is just $2.81, which is much lower than its actual price of $12. So Ford stock is very, very overvalued. How could we calculate intrinsic value of GM's equity using DCF? So no calculation necessary. I encourage you to read my answer very quickly. Since currently GM's free cash flow is negative, we need to bring it to the point. We need to make a projection until it actually becomes positive. And then we can calculate terminal value, which will hopefully be bigger than the present value of all the negative cash flow during the projection period. And then we follow the standard steps of DCF, add up present value of the projection cash flows, add up the present value of the terminal value. That's going to give us EV, subtract total net debt, divide by number of shares outstanding, and we would have the intrinsic share price of GM. Overall, would you rather buy Ford or GM? And my answers, let me show you. I have a long answer here. My take here is that for GM seems look better. Well, let me put it this way. There are two ways to answer this question. One is you can say that you believe in the efficient market hypothesis, at least in the strong form of the efficient market hypothesis. And if you do, then you would be indifferent because the current stock price would perfectly reflect the fundamental value of both Ford and GM. And you can't pick. However, there's plenty of evidence that markets are not always efficient. In my case here, I believe that the market is putting too much emphasis on GM's negative free cash flow. If you look closely, its negative free cash flow is really driven by this huge capex that they're making. They're making capex that's 3 times the size of Ford's capex. And in my mind, that's a good. As a long-term investor, I think that's a good thing. I think it's going to make GM better prepared for the future. Plus, valuation metrics really show that GM is a good deal relative to Ford. So if I had to pick, I would pick GM. Let's do part 2. In part 2, we've got 3 managers. We've got the market. We've got the risk-free return. Let's make some calculations. Let's calculate average return. Let's calculate ST-dev. And sure, and after that, we'll calculate Sharpe ratio. So average is going to be average of these numbers. Standard dev, ST-dev, sample, and we're going to do this one. Let's copy these guys to the right. Let's calculate Sharpe. Sharpe is going to be the average return minus the average risk-free return, which we're going to lock because we're going to copy this to the right, divided by the standard deviation. So Control R. So this is a start, right? So we could see that really the market has the highest Sharpe ratio. It looks like manager A is very similar to the market. Manager B has a little lower Sharpe ratio. Manager C has even a lower Sharpe ratio. However, let's take a look at this question a little closer. We say, well, explain which manager you would pick to manage a portion of your diversified portfolio. Which means that what we really care about is not the Sharpe ratio, but what we care about is alpha. We want to pick a manager this doesn't just have a good Sharpe ratio. We want a manager that returns that are uncorrelated with a diversified portfolio. So we need to calculate alpha associated with each of these managers. For that, we're gonna need a market minus RF. We're gonna need manager A minus RF, B minus RF, and C minus RF. So let's do this guy first. Market minus RF is here. A minus RF is going to be A minus RF. And let's lock the column coordinate on the RF so that we can just copy this to the right. Now let's highlight that whole thing and copy that down, Control D. And we've got our series for calculating alpha. And let's actually also calculate betas. So I'm going to do alpha, I'm going to do beta. I'm just going to do that for these managers. So what's a good way of doing this? Let's do it actually here. And so of course we can use the data analysis add-in, or if you, like me, are a fan of the linest function, that takes a little longer. But I'll do it anyway. We can do that also. So let's do linest. The dependent for manager A is the excess return on manager A. Y is excess return on the market. And we want intercept, and we want additional statistics. Oh darn, I think I forgot to create an array. So let's do that again. Control Shift and Enter. At least on a PC, I believe on a Mac, it's just Control and Enter. So this is the coefficient. This is the standard error. So beta. So this is the slope coefficient. So that's our beta. This is our alpha. Let's actually calculate t-stat on each of these. So this divided, coefficient divided by standard error. So highly significant beta. Control R. Insignificant, basically 0 alpha. So manager A generates 0 alpha. Let's do it this for manager B. I wish I could just copy that, but I can't. So I'm going to highlight this and start typing linest. And here we go. We've got deep manager B's performance, regressed on excess market, and we'll do true and comma and true again. Control Shift Enter. Let's calculate t-stats. Again, let's see, something did not go right. 17, negative alpha of 17. That seems very large, but that's what it's telling us, that it has that the manager B has a negative alpha of 0.17. See, that's not what I remember when I did it the first time. Oh no, it's got just a 0.08. So I did something off here. Let's check that. So I did J and regressed it on H. That's correct. Okay, just gonna escape that. This oh, wait a minute. Maybe this is actually calculated wrongly. Okay, this is calculated wrongly. This is not the here I locked the row coordinate, not the column coordinate. Oh dear. So let's fix that. Let's control F4 this way it should be, and control R. Yes, so I should have really looked. Yes, this is correct, and we're gonna control D, and yes, and we see that the beta is actually 1, alpha is basically 0. For manager B, the alpha is negative 1% almost, and it's statistically significant. It's negative. It's beta is like 1.5. So this is that manager B is terrible. He's got really high beta, high systematic risk, negative alpha. I would be better off with manager A. Let's take a look at manager C. So we'll do Lin est again. Manager C is here, comma, we regress that one market, comma, we'll do true, comma, and true again. Close the parentheses, and we have for this manager, their alpha is actually positive, like 4%, which is really, really high. Its beta is negative, so it's got very low systematic risk. It moves in opposite direction. Let's check if alpha is actually statistically significant, highly statistically significant. So there's no contest here. Manager C is the winner because they've got positive and statistically significant alpha at big manager C. And that's it.